Welcome to vTalkInsight, Allocator's Lens Daily for February 25th, 2026. Today's cross-asset picture is unusual. Equities are hovering near record levels. Treasury yields sit close to year-to-date lows. The dollar is firm, and crypto is under pressure, all while tariff policy and geopolitics are raising the background level of risk. For allocators, the tension between resilient growth, an AI-driven earnings story, and a clear build-up of policy and tail risks is front and center. So let's start with how that is playing out in equities before we connect it to rates, credit, currencies, and commodities. In equities, the headline story still looks benign, but the internals are getting more complicated. The S&P 500 is only a couple of percent below its peak, yet sentiment is capped by persistent uncertainty around a new tariff regime and a sense that tail risks remain underpriced. New and proposed United States tariffs, including talk of lifting broad measures from 10 to 15% and fresh investigations into industrial imports, are forcing a wait-and-see stance in trade-exposed sectors, even as a recent Supreme Court ruling promises more predictable, Congress-driven trade policy further out. Under the surface, leadership continues to be dominated by the AI infrastructure theme, but that trade is clearly maturing. Chip makers and hardware suppliers, such as NVIDIA, AMD, and storage names that have rallied well over 100% year-to-date, are still benefiting from hyperscalers lifting capital expenditure plans by large double-digit percentages, and NVIDIA's next earnings release is a key test of how durable that spending really is. At the same time, investors are rotating away from software and other asset-light names perceived as vulnerable to AI disruption, and toward more capital-intensive areas like utilities, telecoms, financials, and hard asset sectors such as energy and real estate, where obsolescence risk is lower, but returns on capital are more modest. Flows and fundamentals give this mixed picture some support. ETF activity has started the year at record pace, with more money moving into small and mid caps and into European and Asian markets, consistent with a desire to diversify away from a narrow United States growth and AI complex. Macro forecasts still point to United States growth holding above 2% in the next year and S&P 500 earnings potentially rising by the mid-teens by 2026, which, together with possible rate cuts, underpins the case for catch-up in lagging cyclical and industrial sectors, even as top-down valuations face resistance. At the same time, market action in consumer stocks is flashing caution. Staples are up solid double digits, while discretionary names are down, helped by strong reports from giants like Walmart and Costco, but offset by softer breadth and subdued commentary from companies such as Home Depot, which describe home improvement demand as sluggish. Against that backdrop, several risks hang over the equity complex. Analysts warn that volatility still fails to reflect the scale of potential drawdowns given large fiscal deficits, geopolitics, and highly concentrated AI positioning, and domestic affordability pressures in housing, healthcare, food, and energy mean the consumer pillar is more fragile than headline data suggests. Ongoing geopolitical tension, especially in the Middle East and in trade relations between the United States and Europe, supports defense and energy equities, but also increases the probability of an oil or policy shock that equity valuations have not fully priced. For now, the key signposts for allocators are tariff headlines, the evolution of AI-related earnings and capital expenditure, and whether the current rotation toward asset-intensive value and non-United States pockets broadens or fades as we move through the year, which brings us to the rate backdrop that is helping hold indices near the highs. In rates, the message is one of cautious demand for safety alongside ongoing debate about the right level for yields. United States 10-year Treasury yields have slipped to just above 4% and are flirting with year-to-date lows, while the 2 to 10-year spread has flattened to around the high 50s in basis points, pointing to a market that is still wary about the growth outlook. Flows into bonds reflect that caution, with clients who are underallocated to fixed income adding exposure not only to treasuries, but increasingly to aggregate and core plus strategies, seeking broad duration and credit exposure rather than narrow sector bets. The policy story, however, is anything but clear. Inflation has been running close to 3% for more than a year, and several Federal Reserve officials have recently pushed back against early easing, stressing that they need more convincing progress toward the 2% target before cutting. That rhetoric has nudged two-year yields modestly higher and dampened some of the more aggressive rate cut expectations, even as many market participants still look for one or two cuts this year, possibly starting around mid-year under new Fed leadership, and see a somewhat steeper curve as ultimately supportive for risk assets. There are also structural forces that currently support bonds. Ongoing disinflation from goods, steady growth, and AI-driven productivity and capital expenditure are seen as reasons why the recent decline in yields could be sustainable for a time, particularly while geopolitical worries and trade disputes keep safe haven demand elevated. The risk to that benign scenario is well understood in the commodity and geopolitical space. A material oil supply disruption or a renewed tariff shock that meaningfully lifts import prices could reignite inflation, challenge the view of limited stagflation risk, and force a repricing higher in yields. For allocators, that makes the upcoming inflation prints, Fed communication, and any escalation in energy-related tensions critical for judging how durable this low-yield environment really is, and it sets the stage for how credit markets are behaving. Credit markets present a two-speed picture. In publicly traded credit, liquidity is healthy and spreads, while somewhat volatile and high yield, remain consistent with a soft landing narrative rather than an imminent downturn. Commentary stresses that as long as a full-blown recession is not on the near-term horizon, carrying high grade and even parts of high yield still looks workable, and recent weakness in software equities has not yet spilled over into bond or loan markets in a systemic way. Beneath that calm surface, private and structured credit are showing more strain. Senior bankers have compared parts of today's lending standards to the pre-2008 period, warning that rising competition has pushed some institutions toward aggressive structures just as the cost of capital has reset higher. Private credit managers themselves flag that higher rates are likely to trigger meaningful defaults and disruption, particularly in software-heavy portfolios, while early stress is emerging in structured products such as collateralized loan obligation equity tranches, whose price action resembles the mid-2000s. At the system level, growing interdependence between banks and non-bank lenders, with banks providing more funding lines and commitments, adds another layer of complexity if conditions deteriorate. Even with these risks, private credit remains a growth story. Recent returns in the 8 to 10% range, combined with structures like public business development companies that use permanent capital or limited redemptions, have attracted insurance, institutional, and retail money, while also reducing some of the classic run risk seen in open-ended funds. On the innovation side, tokenization and blockchain adoption are starting to reshape how private loans are administered, promising more real-time data, automated covenant checks, and continuous portfolio monitoring in what has historically been an opaque manual space. For multi-asset allocators, the implication is that credit still provides income, but the distribution of risk is widening. The public markets do not yet signal broad stress, but early warning signs in leveraged software borrowers, structured products, and bank-non-bank linkages argue for close monitoring of refinancing calendars, covenant trends, and pricing in the riskiest tranches. How these credit undercurrents evolve will interact directly with both the rate path and equity volatility, and they feed into the next leg of the story in currencies. Currency markets are reflecting the same mix of growth resilience and policy anxiety. The United States dollar has just logged its strongest week of the year against the euro, supported by rising geopolitical tension, concerns over central bank independence, and ongoing legal and political uncertainty that keeps investors leaning toward perceived safe havens. A firm dollar poses a headwind for European corporates, since a large share of their revenues are denominated in dollars, and current projections suggest aggregate earnings growth there may be capped in the mid-single digits as currency translation eats into upgraded growth forecasts. The Japanese yen is another focal point. Markets had priced in more than 50 basis points of Bank of Japan tightening for the year, but recent comments from the Prime Minister questioning the case for further hikes have surprised investors and driven the yen sharply weaker, leaving it as the softest currency in the group of 10. With domestic data subdued and geopolitical tension with China simmering, doubts about the central bank's willingness or ability to normalize policy mean yen weakness could extend, though the gap between market pricing and political reality also sets up the potential for abrupt reversals if policy signals shift. More broadly, currency markets are expected to stay choppy as Supreme Court decisions, trade policy twists, and geopolitical developments generate frequent event risk. Capital flows out of United States equities into Europe and Asia, often targeting sectors seen as less exposed to AI disruption, add another layer of cross-border adjustment that feeds into euro and regional currency dynamics. In digital assets, Bitcoin has been experiencing its sharpest monthly drawdown since the 2022 collapse, down close to 20% and marking a 5-month losing streak, driven by liquidity outflows from stablecoins and exchange-traded products. Yet some large investors still view the $60,000 area as an accumulation zone and point to rising institutional adoption and clear regulation as long-term positives, underlining that crypto continues to behave as a high beta, sentiment-sensitive slice of the FX and alternative asset complex. Those currency and crypto moves tie directly into the commodity and inflation picture. Commodities are sitting at the intersection of geopolitics, inflation, and growth expectations. In oil, analysts see a tug-of-war between a sizable projected supply surplus and a meaningful geopolitical risk premium. The United States has deployed its largest military presence in the Middle East since the early 2000s, while concerns over Iran's nuclear ambitions and fresh United Kingdom sanctions on Russian energy revenues highlight the possibility of a Gulf supply disruption. One major house has lifted its near-term Brent and WTI forecast by around $6 per barrel to reflect that risk, but still expects prices to drift toward about $60 by year-end, based on a growing global surplus that could reach more than 2 million barrels per day by 2026 if there is no major shock. Equity markets within commodities tell their own story. Energy shares have outperformed technology since last autumn, supported by lower costs, better technology, and higher margins at today's prices, which make the sector look more resilient than in previous cycles. Investors also appear to believe that current supply growth is temporary and that long-term oil demand will remain robust, even as sanctions on Russia and uncertainty around European support for Ukraine keep the outlook for flows finely balanced. At the same time, European defense budgets are expected to stay structurally higher as the United States pushes allies to shoulder more of the burden, and domestic defense investment remains politically popular, providing another medium-term demand anchor for selected industrial and commodity-related names. Precious metals sit on the other side of the commodity risk spectrum. Structural erosion of the United States dollar's reserve status, driven by concerns over deficits and asset security, is encouraging central banks and groupings such as the BRICS to add to gold holdings. That steady official sector demand, combined with the perception that markets remain underhedged for low probability but high-impact shocks, has reinforced gold's role as a portfolio hedge even as other risk assets, including Bitcoin, experience bouts of volatility. Together, the oil, energy equity, and gold narratives underscore how commodities are central to the key macro scenarios, for benign disinflation with surplus supply to stagflationary outcomes if a major disruption emerges, and they feed back directly into the rates, FX, and equity paths we discussed earlier. Pulling it all together, today's cross-asset picture shows equities still supported by AI-driven earnings and steady growth, even as leadership narrows and tariff uncertainty, consumer fragility, and underpriced tail risks argue against complacency. Rates markets are signaling caution with 10-year yields near their lows and investors adding to broad bond exposure, while credit remains orderly on the surface but reveals growing stress in private and structured segments tied to leverage borrowers and complex intermediation chains. In FX, a stronger dollar, a vulnerable yen, and choppy euro dynamics highlight the importance of policy credibility and geopolitical risk, and crypto's drawdown serves as a high beta barometer of risk appetite. Commodities round out the picture, with oil caught between surplus and shock risk, energy equities and defense names benefiting from higher for longer security spending, and gold absorbing the dollarization flows and demand for crisis insurance. For allocators, the key watch points are the evolution of tariff policy, upcoming inflation and Fed decisions, the next wave of AI earnings, and any escalation in the Middle East that could push commodities from contained risk premium toward a more disruptive regime. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.